WorldCom was an American telecommunications company. During its heyday, WorldCom was one of the major long-distance providers in the United States. The corporation is best recognized for its role in one of the country's largest accounting scandals, which came on the heels of the Enron and Tyco frauds. This came when it was uncovered that the corporation was lying about its financial records. WorldCom was also involved in one of the most massive bankruptcies of all time. The company came out of bankruptcy, rebranded itself, and its network assets were sold to Verizon. Understanding WorldCom. Today, WorldCom is synonymous with accounting fraud and serves as a cautionary tale to investors about the possibility that a situation is not what it seems. The business was first established as a long-distance discount service in 1983. Murray Waldron, William Rector, early investor Bernard Ebbers, and their business associates founded it following the split of AT&T. With the help of $650,000 loan, the group was able to purchase the equipment needed to route long-distance calls. Since courts ordered AT&T to lease its phone lines to new companies at low prices, Ebbers, the company's CEO, was able to offer his customers extremely low rates. This gave him the opportunity to buy up to 30 other telecom firms, turning the business into one of the top long-distance phone providers in the United States. At the peak of the dot-com bubble, WorldCom's market capitalization grew to $186 billion. When the tech boom turned to bust and firms cut spending on telecom services and equipment, WorldCom used accounting methods to keep the impression of ever-increasing profits. Many investors were skeptical of Ebbers' story by that point, especially after the Enron scandal broke in the summer of 2001. In 2002, it was revealed that Ebbers borrowed $408 million from WorldCom's board of directors to cover margin calls on loans secured by company stock. The SEC started looking into the company at the same time as its accounting fraud and true financial status became apparent. Consequently, Ebbers met his downfall and left his position as CEO on April 30, 2022. He was found guilty in 2005 of conspiracy, securities fraud, and making false filings. He received a 25-year jail sentence. Cooking the books, WorldCom suffered a loss as a result of multiple circumstances. The business actively sought acquisitions, acquiring competitors' businesses in an effort to increase its market share. This resulted in a significant decline in revenue and rates, which further put the business in the negative. Executives needed a way to prove WorldCom was still financially viable to its board and shareholders. In order to conceal its financial situation, WorldCom employed a number of suspicious accounting procedures, inflating its profits. This resulted in billions of dollars in capital expenditures being improperly recorded on the books. But this was hardly a sophisticated fraud. WorldCom recorded expenses as investments in order to increase net income and cash flow, concealing its declining profitability. By capitalizing expenses, it overstated profits by $3.8 billion, including $3.55 billion in 2001 and $797 million in the first quarter of 2002, resulting in a net profit of $1.38 billion rather than a net loss. The whistleblowers. Several people played important roles in exposing the WorldCom fraud. Cynthia Cooper, Vice President of WorldCom's Internal Audit Department, and Gene Morse, another auditor, were among those involved. They started to notice other discrepancies in the business's financial records. Cooper and Morse conducted independent investigations and audits. Chief Financial Officer Scott Sullivan of the corporation challenged them and asked for a postponement of the procedure. They contacted KPMG, the external auditor that replaced Arthur Andersen, as well as WorldCom's audit committee. Cooper's dedication won her the title of Person of the Year from Time, and the publication even put her on its cover in 2002. She now works as a consultant, author, and speaker who is well known throughout the world. WorldCom bankruptcy. After everything began to fall apart, the company was unable to continue. In fact, WorldCom had to adjust its earnings for the 10-year period from 1999 to 2002 by $11 billion, and the fraud was estimated to be in the neighborhood of $79.5 billion. The only way out was bankruptcy. Just 1 month after Arthur Andersen, the company's now former auditor, was found guilty in court and had his accounting license suspended, WorldCom filed for Chapter 11 bankruptcy on July 21, 2002. The company's debt to creditors at this point could have reached $7.7 billion. In its filing, the company noted $107 billion in assets and $41 billion worth of debt. The filing permitted WorldCom to carry out some restitution. By doing this, services might be continued for current clients. In addition, WorldCom was able to maintain its assets and pay its staff. Though it lost its appeal in the business world, it also gave much-needed time for restructuring. Legal proceedings. Although no one admitted to their role in the incident, multiple players were to blame, some within the firm, and others who were not even WorldCom employees. However, due to their roles in the company's accounting scandal, a number of employees received harsh punishments. Bernard Ebbers was convicted on 1 count of securities fraud, 1 count of conspiracy, and 7 counts of fraud related to false SEC filings. In 2005, he received a 25-year prison sentence. However, on December 18, 2019, Ebbers was given an early release from prison due to health concerns, having completed around 13 years of his term. After pleading guilty and providing evidence against Ebbers, former CFO Scott Sullivan was sentenced to 5 years in prison. Finally, WorldCom was a telecommunications business that took pleasure in offering its consumers low-cost, long-distance services. However, the company's aggressive acquisition strategy and falling revenues sent it into a downward spiral, eventually leading to one of the greatest accounting frauds and bankruptcies in the United States. The corporation employed false accounting procedures to conceal its losses while appearing to be wealthier than it was, allowing it to maintain its status as an investment choice. Although it managed to restructure and emerge from bankruptcy, WorldCom's example helped corporate management teams and investors learn a valuable lesson. If something looks too good to be true, it probably is. Thanks for tuning in to another eye-opening episode on capital crimes, where we uncover the truth behind the dollars and cents. Before you go, fam, remember this: knowledge is power, and action is key. If you're as passionate about uncovering financial wrongdoing as we are, then don't forget to drop a comment below with your thoughts. Smash that subscribe button and share this video with the squad. Together, let's keep exposing the dark side of the financial world and keep chasing the truth.